June 2026. Over $300 trillion in global debt is cracking the backbone of the world's banks. Regulators from Washington to Brussels have quietly imposed new rules, limits on withdrawals, automated liquidity tests, and real-time transaction reporting, all designed to keep the public from ever seeing the system's real stress. The most powerful central banks say it is about stability, but as personal access to money is reprogrammed behind the scenes, even experts warn a financial reset is on the table. What happens when your money is held hostage by rules you never saw coming? The real story starts now. Across Europe, Asia, and the Americas, the world banks are sitting on a mountain of government debt, much of it once considered the safest asset in finance. In 2025, that confidence began to unravel. Italian banks now hold nearly 400 billion euros in domestic bonds, French banks over 350 billion euros, and Spanish banks above 200 billion euros. Even the largest U.S. institutions, JP Morgan, Citi, and Bank of America, carry hundreds of billions in treasuries, using them as the backbone of their liquidity reserves. But as interest rates climbed and political turmoil shook markets, the value of these government bonds started to drop. Italy's 10-year yield jumped from 3.8% to 4.6% in just a few weeks. French bonds followed, with yields rising from 2.7% to 3.4%. In the UK, gilt yields swung between 3.9% and 4.3% after a series of policy shocks. For banks, this was not just a paper loss. Under international accounting rules, most of these bonds are marked to market, so every drop in value hits the bank's balance sheets immediately, shrinking their capital cushions and squeezing their ability to meet regulatory liquidity requirements. Supervisors responded by raising the stakes. Across the Eurozone, regulators increased the haircut on bonds from countries seen as risky, up to 40% for Italian, Greek, and Spanish debt. UK regulators imposed new liquidity premiums on long-dated gilts. Even core French bonds faced higher haircuts and tighter eligibility standards. In the US, while treasuries remained the gold standard, stress test scenarios started to assume 3 to 7% markdowns, forcing banks to rethink their strategies. Haircuts and tighter standards became the new reality. These changes hit hardest during sudden market shocks. In Italy, a bout of political instability wiped 6 billion euros off major banks' liquid assets in less than a month. French giants like SocGen and BNP Paribas saw 2 billion euros in losses after fiscal deficit warnings. UK banks flagged sharp swings in their liquidity coverage ratios as gilt values dropped. For a typical Eurozone bank, just an 80 basis point jump in yields could erode the value of its sovereign bond buffer by more than half a percentage point, enough to trigger emergency funding moves or asset sales. Emergency funding became a real possibility. Central banks scrambled to keep the system afloat. The ECB and Bank of England expanded their repo and asset swap facilities, letting banks exchange stressed bonds for cash or higher quality collateral. Regulators coordinated new rules on what counted as high-quality liquid assets and how much of a haircut to apply when volatility spiked. The Basel Committee proposed even stricter standards, warning that banks with heavy concentrations of risky sovereign debt could face outright exclusion from top-tier liquidity status. Central banks moved quickly behind the scenes. The result is a banking system under relentless pressure, forced to navigate a world where the very assets designed to keep it safe have become a source of risk. With over $300 trillion in global debt and regulators rewriting the rules on the fly, every move in the bond market now ripples through the core of the financial system, testing its ability to withstand the next shock. Liquidity coverage ratios and net stable funding ratios have become the silent sentinels of global banking. Every major institution now lives and breathes these numbers. The liquidity coverage ratio, set at 100%, demands that a bank holds enough high-quality liquid assets to cover 30 days of severe outflows. The net stable funding ratio, also locked at 100%, requires stable funding over a full year. These are not abstract targets, they are hard lines. When bond prices drop or haircuts rise, a bank's liquidity coverage ratio can slip below that threshold in hours, not weeks. That is when internal alarms go off. In 2025, the Federal Reserve took an unprecedented step. It announced plans to publish the models and assumptions behind its annual stress tests, inviting public scrutiny before scenarios are finalized. For the first time, banks and analysts could see exactly how the Fed calculates hypothetical losses, revenue shocks, and liquidity drains. The move was designed to restore trust after a year of volatile markets and surprise regulatory interventions. But it also revealed just how sensitive the system has become to rapid swings in asset values. Transparency changed the game. Banks now run their own reverse stress tests, searching for the exact combination of events that could tip their liquidity coverage ratio or their net stable funding ratio below the regulatory minimum. This process goes far beyond the old generic scenarios. A typical model might test the impact of a 40% haircut on Italian bonds, a sudden 10% deposit outflow, or a spike in overnight funding costs. If the math shows a breach, contingency plans kick in. Asset sales, repo borrowing, even temporary limits on withdrawals. For large U.S. banks, the 2025 stress test templates included 3 to 7% markdowns on Treasury holdings, enough to force a rebalancing of entire portfolios. The transparency shift is global. European regulators now require banks to disclose their liquidity coverage ratio and net stable funding ratio calculations in detail, including the underlying assumptions about sovereign risk and funding volatility. The Basel Committee's latest proposal calls for even more granular reporting, with banks forced to show how their liquidity positions would react to market shocks in real time. These disclosures are no longer just for supervisors. They are meant for investors, counterparties, and indirectly, the public. The message is clear. The rules are tightening and the thresholds are visible. Banks know exactly where the tripwires lie, and regulators are watching every move. This next rule is the most important. The next section will look at how these metrics translate into real-world controls. What happens when the numbers say a bank's liquidity is running out, and who decides when to pull the levers? On December 1st, 2025, a new federal rule transforms how real estate transactions are tracked in the United States. Title and settlement agents must now report every all-cash residential property transfer to legal entities or trusts, no matter the city or state. The days of limited geographic targeting orders are over. A single nationwide standard replaces them, feeding transaction data directly into a federal pipeline. Information on buyers, sellers, and the true owners behind shell companies moves almost instantly to law enforcement and regulators. The process is precise and mandatory. When a property is sold without a mortgage, the title or settlement agent files a report with the Financial Crimes Enforcement Network, known as FinCEN, within a set reporting window. These reports detail the purchase price, property address, and, crucially, the names, taxpayer identification numbers, and ownership structures involved. If a trust or shell company is part of the deal, agents must identify the individuals who control it. The data is then checked against sanctions lists, flagged for suspicious activity, and stored for future audits. For the first time, the responsibility for anti-money laundering compliance shifts from banks to the intermediaries who close the deals. Title companies, escrow agents, and lawyers, many new to these protocols, find themselves at the center of financial scrutiny. The rule is clear. Every qualifying transaction must be reported, regardless of suspicion. Non-compliance brings penalties, license suspension, or even criminal charges. Real-time scrutiny means property transfers can be delayed or flagged if the system detects anything unusual. A wire from an unfamiliar country, inconsistencies in ownership documents, or a series of rapid purchases by related entities can all trigger deeper investigation. For buyers and sellers, this introduces new friction at closing. Delays might last hours or days as compliance teams resolve alerts and review documentation. The December 2025 rule signals only the start. The Financial Crimes Enforcement Network's proposed anti-money laundering regulations, open for comment through 2026, encourage financial institutions to design their own risk-based compliance systems. Both banks and non-bank intermediaries are being pushed to use advanced analytics and artificial intelligence to spot illicit patterns. Yet with this flexibility comes closer oversight. Every flagged transaction becomes another data point in an expanding web of regulatory attention. Globally, these systems are converging. United States rules are being aligned with European and Asian standards as regulators worldwide coordinate to close gaps exploited by cross-border money flows. Settlement agents in cities like London, Singapore, and Frankfurt now face similar mandates, channeling transaction data into national and international monitoring networks. The result is a tightening net of real-time reporting, tracking the movement of money and property with unprecedented detail. For individuals and businesses, the impact is often invisible but significant. A family buying a home through a trust, a small business wiring funds abroad, even retirees transferring assets, all may encounter compliance-driven delays, extra documentation, or the risk of transactions being flagged for further review. The promise of seamless finance is giving way to a world where every major transaction leaves a permanent, scrutinized record. As these systems take hold, the boundaries of financial privacy and access are being redrawn, and the gears of commerce turn under new oversight. Behind closed doors, banking regulators have quietly built a network of emergency backstops, tools designed to keep the financial system standing when markets falter. In the United States, the FDIC maintains a confidential list of waivers and exemptions, updated annually, that allow banks to sidestep certain resolution requirements under stress. The 2025 waiver list, set for review next July, includes broad leeway for large institutions to propose alternative resolution plans, bypassing the once mandatory bridge bank strategy and failure scenario modeling. This flexibility is not just legal fine print. It is a response to the reality that, in a crisis, rigid playbooks can fail. Central banks have expanded their own safety nets. During the 2020 pandemic panic, the Federal Reserve opened its repo window to unprecedented scale, pumping over $450 billion into the system in a matter of weeks. Those swap lines, temporary agreements to exchange currencies with foreign central banks, became the backbone of global liquidity, stretching from New York to Frankfurt, London, and Tokyo. The templates forged in that emergency have since been refined. Today, the Federal Reserve, the ECB, and the Bank of Japan maintain standing swap lines, ready to activate at a moment's notice if funding markets freeze or cross-border payments jam. But these backstops are not automatic guarantees. Each central bank retains discretion over when and how to deploy them. The IMF, meanwhile, has spent the past 2 years revising its own conditional liquidity tools. The short-term liquidity line, launched in 2020, now includes protocols for instant drawdowns by countries facing acute funding pressure, provided they meet strict transparency and regulatory standards. Recent IMF board summaries reference confidential memoranda with European and Asian central banks, outlining how national authorities can trigger fund support in tandem with local crisis measures. In practice, this means that if a major bank enters resolution, national central banks and the IMF can coordinate rapid-fire liquidity injections, stacking national and international resources to keep depositors whole and markets functioning. Yet gaps remain. Not all countries qualify for IMF rapid access lines. Even among advanced economies, the legal authority to deploy swap lines or activate waivers can be contested in the heat of a crisis. In the US, the FDIC's exemptions are reviewed behind closed doors, with the details shielded from public scrutiny. In Europe, the Single Resolution Board must coordinate with national regulators, each with its own playbook and political constraints. The result is a patchwork of contingency plans, robust on paper, but tested only in simulations and emergency drills. For banks, the message is clear. Official safety nets exist, but they are neither uniform nor guaranteed. Institutions are expected to prepare their own contingency funding plans, stress-tested against scenarios where central support may arrive late or not at all. The quiet coordination among the FDIC, the IMF, and central banks forms a hidden scaffolding beneath the visible rules, shaping how liquidity will flow or freeze when the next shock hits. As 2026 approaches, the question for depositors and businesses is not just whether their bank is solvent, but whether the backstops behind it are ready and real. A Spanish furniture exporter sits at her desk, watching the progress bar on her bank's online portal inch forward. She has just wired 50,000 euros to a Turkish supplier, a routine payment or so it seemed. But the transfer stalls. The bank's compliance team has flagged the transaction for review, citing new real-time cross-border monitoring rules. The exporter's business depends on tight delivery schedules, but now the The payment sits in limbo for 72 hours, a painful delay. The automated system has detected a new counterparty in a higher-risk jurisdiction, triggering enhanced due diligence. The bank requests additional documents, invoices, proof of delivery, and details about the supplier's ownership. Each hour of delay threatens late fees and strains the relationship with her overseas partner. For small exporters across Europe, these compliance-driven holds are becoming common. It is not just large suspicious sums that draw scrutiny. Any cross-border payment can be swept up if it fits a risk profile. Halfway around the world, a Philippine nurse in Singapore tries to send her usual $300 home to Manila. The remittance window that once promised overnight delivery now warns of possible delays. Her bank requests an employment letter, details about her family, and the reason for the transfer. Under new reporting standards, every cross-border remittance is logged, sender and recipient scrutinized, and the purpose matched against sanctioned lists. The $300 sits in a compliance queue for 24 hours, sometimes longer, before it is released. Her family's rent payment is late, and she scrambles to provide extra paperwork. For millions of migrant workers, the promise of instant remittances has faded, replaced by a growing list of questions and unpredictable waiting times. Neither the exporter nor the nurse has done anything wrong. Their transactions are caught in a system designed to spot illicit finance, but the net is wide. Enhanced Know Your Customer rules, real-time monitoring, and risk-based holds are now standard. For households and businesses, the friction is real. Delayed payments, missed deadlines, and a growing sense that access to one's own money is no longer guaranteed. As these stories play out in homes and offices worldwide, the impact of regulatory change becomes personal, measured not in policy memos but in hours lost and trust eroded. In January 2025, the European Union Digital Operational Resilience Act, DORA, comes into force. Every digital process, from the largest payment engine to the smallest API, must be monitored in real time. Withdrawal limits, automated freezes, and transfer blocks are no longer buried in code. Each instruction is logged, traceable, and subject to audit. If an algorithm denies access to funds, regulators must be able to follow the logic step by step, from the first input to the final outcome. No more black boxes. DORA's mandate is clear: transparency at the code level, enforced by law. The European Union AI Act, adopted in June 2025, extends this requirement. Any artificial intelligence used in credit checks, fraud detection, or transaction controls must produce a readable trail. Banks are required to document how every flagged payment or unusual withdrawal triggers a specific action. If a customer's funds are held or a limit is imposed, a human reviewer must be able to reconstruct the algorithm's reasoning. Failure to comply brings penalties, making explainability not just best practice, but a legal necessity. China's central bank has already moved from theory to practice. The digital yuan, known as ECNY, operates on a tiered wallet system. Basic wallets cap balances at 10,000 RMB, about $1,400, with higher tiers unlocked by providing more identification. During financial stress, the People's Bank of China can instantly lower these caps, nationwide or by region, through code. Over 325 million digital wallets are now active, and the rules governing them are hardwired into the system, allowing real-time throttling of withdrawals and transfers. Control is built into the money itself. In the United States, the Genius Act sets a July 2026 deadline. By then, every federally regulated bank must ensure that any AI or machine learning tool used for monitoring accounts or setting transaction limits is fully auditable. Logic files must be available for inspection, showing precisely how and why a rule was triggered. Across continents, regulators are embedding control into software itself. Withdrawal caps, transfer blocks, and instant reporting are no longer just policy. They are programmable, enforceable, and ready for the next crisis. The human impact is immediate. Access to your money can be limited or delayed by code, and the pathway to restore access depends on how well that code is documented and audited. This is programmable architecture in action. It can stop runs, it can isolate risk, and it can enforce compliance automatically. But it also puts enormous power into lines of code and the hands of whoever controls the keys. As these systems come online, the world will need clear rules, robust oversight, and public scrutiny to ensure that automated controls protect people not just balance sheets. Right now, every major central bank is rewriting the rules that decide how you access and move your money. As digital controls and automated limits become standard, personal finance shifts from private choice to programmed compliance. The safeguards of yesterday are not guaranteed tomorrow. The power to reshape your financial freedom is no longer just in your hands. The next move belongs to those watching the system, not just using it.